What if I told you that the biggest mistake most investors make isn't picking the wrong stock, but playing a game that was rigged against them from the start? For decades, millions of hardworking Americans have done exactly what they were told to do. They saved diligently, they trusted experts, they paid high fees to fund managers who promised to beat the market. And yet, after 20, 30, even 40 years of investing, many of them ended up wondering the same thing. Why didn't my results match the hype? John C. Bogle, founder of Vanguard and the man who quietly changed investing forever, had a brutally honest answer: because Wall Street is designed to serve itself first and investors second. In Common Sense on Mutual Funds, Bogle doesn't sell you a secret strategy or a flashy shortcut. Instead, he does something far more dangerous to the financial industry. He tells you the truth. A truth so simple, so obvious that most people overlook it completely in the long run. You don't need to be smarter than the market. You just need to stop letting others siphon off your returns. This book isn't about getting rich quick. It's about not getting poor slowly. Bogle pulls back the curtain on how mutual funds actually work, how fees compound against you year after year, how chasing past performance quietly destroys returns, and how complexity is often used to confuse investors rather than help them. He explains why most professional fund managers fail to outperform the market, not because they're dumb, but because costs, taxes, and turnover make outperformance mathematically unlikely. And here's the uncomfortable part: even when a fund has beat the market for a while, the odds that it keeps doing so are shockingly low. So why do people keep trying? Because Wall Street sells hope better than math. Bogle's message is a wake-up call. He argues that successful investing isn't about excitement, prediction, or genius. It's about discipline, patience, and humility. It's about accepting what you can't control, market returns, and focusing relentlessly on what you can. Costs, diversification, time, and behavior. This book challenges the idea that investing should feel thrilling. In fact, Bogle would say that if your portfolio feels exciting, you're probably doing it wrong. What makes Common Sense on Mutual Funds so powerful is that it doesn't just tell you what to do. It reshapes how you think. It forces you to see investing as a lifelong journey, not a series of bets, as a system, not a gamble, as a way to capture the market's returns, not chase illusions. In a world obsessed with hot tips, market predictions, and financial gurus, John Bogle's voice is calm, rational, and almost rebellious. Because sometimes, the smartest move isn't outsmarting everyone else. It's simply having the courage to embrace common sense. In Chapter 1, John C. Bogle sets the foundation for the entire book by explaining one core idea: successful investing is a long-term discipline, not a short-term game. He opens by reminding investors that markets are unpredictable in the short run, but remarkably reliable over long periods of time. The problem is not market uncertainty itself, it's how investors react to it. Bogle introduces the metaphor of chance and the garden. The market, he explains, is full of randomness, noise, and short-term fluctuations. This is chance. But long-term investing is like tending a garden. Results come not from constant interference, but from patience, consistency, and letting compounding do its work. Investors who constantly dig up their portfolio to check progress usually damage it. A key point in this chapter is the difference between speculation and investment. Speculation focuses on predicting what prices will do next. Investment focuses on owning productive assets and participating in their long-term growth. Bogle argues that most investors fail because they behave like speculators, even when they believe they are investing. He also explains that time is the investor's greatest ally, but only if behavior doesn't sabotage it. The stock market has historically delivered solid long-term returns, but those returns are earned unevenly. Investors who jump in and out based on headlines, emotions, or recent performance often earn far less than the market itself. Another major lesson in this chapter is the importance of realistic expectations. Bogle cautions against believing that high returns can be achieved without high risk. He stresses that long-term returns are driven by fundamental factors: earnings growth, dividends, and valuation, not excitement or forecasts. When expectations rise to high, future returns almost always disappoint. Bogle also introduces an idea that reappears throughout the book: costs matter relentlessly. Even in a market that delivers strong long-term returns, excessive costs, turnover, and taxes quietly erode what investors actually keep over decades. These small leaks compound into massive losses. Chapter 1 ultimately sets the mindset Bogle wants investors to adopt. Ignore short-term noise. Accept uncertainty. Stay invested. Keep costs low. Let time and compounding do the heavy lifting. The message is clear. The winning strategy is not brilliance, but discipline. Investors who respect the long term and resist the temptation to outsmart the market put the odds firmly in their favor. In Chapter 2, John C. Bogle explains where investment returns actually come from and why most investors misunderstand this basic concept. His core argument is simple but powerful. Investment returns are not mysterious, and they do not come from manager skill alone. They are driven by a small number of fundamental components that can be clearly identified and measured. Bogle breaks total market returns into two main sources. The first is investment return, which comes from business fundamentals, dividend income, and earnings growth. These factors are relatively stable over time and tied directly to the real economy. The second source is speculative return, which comes from changes in market valuation, such as price-to-earnings ratios. Speculative return is unpredictable and driven largely by investor psychology. Using Occam's razor, the principle that the simplest explanation is usually the correct one, Bogle argues that long-term returns should be analyzed using the fewest necessary variables. When investors or fund managers introduce complex theories, forecasts, or tactical strategies, they often obscure the truth rather than improve results. A major lesson in this chapter is that speculative return dominates in the short run, but disappears in the long run. Valuation changes can boost or hurt performance temporarily, but over decades, returns inevitably revert to fundamentals. Investors who rely on speculation are betting on forces they cannot control. Bogle also highlights the danger of extrapolating past performance. When markets deliver unusually high returns, investors often assume those returns will continue. In reality, high returns frequently reduce future returns because valuations become stretched. This misunderstanding leads to disappointment and poor decision-making. Another critical point is the distinction between gross returns and net returns. Even when markets deliver strong gross returns, investors do not receive all of them. Costs such as management fees, trading costs, taxes, and sales charges reduce what investors actually keep. These costs are certain, while excess returns from active management are uncertain. Bogle emphasizes that the arithmetic of investing is unavoidable. Before costs, all investors collectively earn the market return. After costs, investors as a group must underperform the market. This makes widespread outperformance mathematically impossible. Chapter 2 reinforces a key theme of the book. Investing success does not come from prediction or complexity. It comes from understanding fundamentals, minimizing costs, and avoiding speculation. The takeaway is clear. Long-term investors should focus on capturing market returns efficiently, not trying to outguess them. Simplicity, realism, and discipline consistently beat hope, hype, and complexity. In Chapter 3, John C. Bogle addresses one of the most misunderstood topics in investing: what actually determines portfolio performance. He challenges the common belief that superior returns come primarily from selecting the right funds or managers. Instead, Bogle argues that asset allocation, not security selection, is the dominant driver of long-term investment results. Bogle begins by explaining performance attribution, the process of identifying where returns come from. Numerous studies show that the majority of a portfolio's return variability over time is explained by how assets are allocated among major categories such as stocks, bonds, and cash. This means that deciding how much to invest in equities versus fixed income matters far more than which specific funds are chosen within those categories. He emphasizes that asset allocation reflects an investor's risk tolerance, time horizon, and financial goals. There is no universally correct allocation. Younger investors with long time horizons may accept higher equity exposure, while older investors or those nearing retirement may require greater stability. The mistake many investors make is adjusting allocation based on market conditions rather than personal circumstances. Bogle strongly criticizes tactical asset allocation, where investors attempt to shift between asset classes to anticipate market movements. He explains that these decisions are essentially market timing under a different name. Since markets rapidly incorporate information, predicting short-term movements between asset classes is extremely difficult and often counterproductive. Another key point in this chapter is the importance of maintaining a consistent allocation over time. Market fluctuations naturally cause allocations to drift. Stocks rise faster than bonds in bull markets and fall harder in bear markets. Bogle advocates disciplined rebalancing to restore the original allocation, which enforces buying low and selling high without relying on forecasts or emotions. Bogle also warns against overcomplicating asset allocation. He argues that adding too many asset classes, strategies, or specialty funds often increases costs and confusion without meaningfully improving results. Simplicity improves investor behavior, which is a critical but often ignored factor in long-term success. Throughout the chapter, Bogle reinforces a central theme: investors should focus on decisions they can control. Asset allocation is one of those decisions. Market returns are uncertain, but choosing a rational allocation and sticking with it dramatically improves the odds of achieving long-term goals. The takeaway from Chapter 3 is clear: get asset allocation right, keep it simple, stay disciplined, and resist the temptation to chase performance. Most investment success is determined before any fund is ever selected. In Chapter 4, John C. Bogle makes a clear and direct case for simplicity in investing. He argues that complexity is not a sign of sophistication, but often a source of poor results. Most investors believe that more strategies, more funds, and more activity will lead to better performance. Bogle explains why the opposite is usually true. Bogle begins by pointing out that financial markets are already complex. Adding layers of complexity through frequent trading, exotic strategies, or narrowly focused funds does not reduce risk, it increases it. Complexity raises costs, makes portfolios harder to understand, and encourages emotional decision-making. A major theme of this chapter is behavioral discipline. Simple investment plans are easier to maintain during market stress. When investors understand exactly what they own and why they own it, they are far more likely to stay the course during downturns. Complex portfolios, by contrast, often lead to confusion, second-guessing, and panic-driven decisions at the worst possible times. Bogle also discusses how the investment industry actively promotes complexity. New products, strategies, and fund variations are marketed as solutions to every market condition. In reality, many of these offerings exist because they are profitable for fund companies, not because they improve investor outcomes. Complexity becomes a sales tool rather than a benefit. Another key point is that simplicity enhances cost control. Straightforward portfolios tend to have lower expense ratios, lower turnover, and fewer tax consequences. Since costs are one of the few variables investors can fully control, simplicity directly improves long-term net returns. Bogle emphasizes that simplicity does not mean laziness or ignorance. It means focusing on the essential drivers of success: broad diversification, appropriate asset allocation, low costs, and long-term discipline. Investors do not need to understand every market development or economic forecast to succeed. They need a sound structure and the patience to let it work. He also warns against the illusion of control. Complex strategies often give investors the feeling that they are actively managing risk, when in reality they are increasing uncertainty. Simpler approaches accept market volatility as unavoidable and manage it through diversification and time. The core message of Chapter 4 is that investment success is not achieved by doing more, but by doing less correctly. By reducing complexity, investors improve clarity, behavior, and outcomes. Bogle's conclusion is straightforward: come down to where you ought to be. Build a simple, understandable investment plan, minimize unnecessary activity, and allow long-term compounding to work without interference. In Chapter 5, John C. Bogle presents one of the central ideas of the book: index investing consistently outperforms active management over the long term. He frames indexing not as a theory, but as a conclusion supported by decades of real-world evidence. Bogle begins by explaining the basic logic of indexing. An index fund simply seeks to own the entire market, capturing its returns at minimal cost. Unlike active funds, index funds do not attempt to predict winners, time the market, or outperform competitors. Instead, they accept the market return and avoid the costs that cause most investors to fall short of it. The key insight in this chapter is the arithmetic of investing. Before costs, all investors collectively earn the market's gross return. After costs, management fees, trading expenses, taxes, and sales charges, investors as a group must underperform the market. Since index funds operate at extremely low cost, they retain a far greater share of the market's return than actively managed funds. Bogle directly challenges the promise of active management. While some funds may outperform temporarily, he shows that consistent long-term outperformance is rare and unpredictable. Past success is often the result of luck rather than skill, and even skilled managers face structural obstacles such as asset growth, higher trading costs, and tax inefficiency. Another important point is survivorship bias. Investors tend to notice only the successful funds while ignoring those that failed or were merged away. This creates the illusion that beating the market is easier than it actually is. When all funds are considered, the average active fund significantly lags behind the index. Bogle also addresses common objections to indexing, including the claim that markets are inefficient or that superior managers can be identified in advance. He argues that even if inefficiencies exist, the costs of exploiting them usually exceed the benefits for most investors. The chapter emphasizes that indexing is not about settling for average performance. It is about achieving above-average results relative to other investors. Because most investors incur higher costs, the low-cost index investor ends up ahead over time. Bogle concludes that indexing represents the triumph of experience over hope. Hope drives investors to chase outperformers and complex strategies. Experience shows that simplicity, diversification, and low costs win. The takeaway from Chapter 5 is direct and practical. Own the market, keep costs low, stay invested, and let compounding work. Indexing is not exciting, but it is effective, reliable, and grounded in reality. In Chapter 6, John C. Bogle examines the popular practice of equity-style investing, such as dividing stocks into categories like growth versus value and large cap versus small cap. He explains why these classifications are widely used and why relying on them too heavily often leads investors astray. Bogle begins by acknowledging that equity styles can help describe market behavior, but he cautions that style boxes are descriptive, not predictive. Investors frequently assume that certain styles will outperform in specific market environments. In reality, leadership among styles shifts unpredictably, often in sharp and sudden reversals. Using the tic-tac-toe metaphor, Bogle illustrates how investors jump from one style square to another, chasing whichever category has recently performed best. This behavior creates a cycle of buying high and selling low. By the time a style becomes popular and widely recommended, much of its outperformance has already occurred. A central point in this chapter is that style rotation is a form of market timing. Attempting to overweight or underweight growth, value, small cap, or large cap stocks requires forecasting future market trends. Bogle argues that these forecasts are rarely accurate and that even professional managers struggle to execute them consistently. Bogle also highlights how style investing increases portfolio turnover and costs. Funds that aggressively pursue style leadership trade more frequently, incur higher transaction costs, and generate taxable gains. These costs reduce net returns and often outweigh any temporary advantage gained from style shifts. Another important issue Bogle raises is style drift. Many funds marketed under a specific style label gradually change their characteristics in response to market conditions or performance pressure. This undermines the very purpose of style diversification and makes it difficult for investors To maintain a coherent asset allocation, rather than rejecting style diversification entirely, Bogle advocates a total market approach. By owning the entire equity market through broad index funds, investors automatically participate in all styles at all times. When growth stocks outperform, they benefit. When value stocks lead, they benefit as well without making active bets. Bogle emphasizes that long-term equity returns are driven by business fundamentals, not style labels. Over time, all equity styles are subject to the same forces of earnings growth, dividends, and valuation. The takeaway from Chapter 6 is clear. Style chasing adds complexity, cost, and behavioral risk without reliably improving results. Investors are better served by broad diversification, low turnover, and patience. Bogle's message is consistent with the rest of the book. Own the whole market, avoid tactical bets, and let long-term compounding work without interference. In Chapter 7, John C. Bogle turns his attention to bonds and addresses a common concern among investors: whether bonds are still worth holding, especially during periods of low interest rates. He challenges the view that bonds are a losing investment and explains their essential role in a long-term portfolio. Bogle begins by clarifying what bonds are designed to do. Unlike stocks, bonds are not meant to maximize returns. Their primary function is stability, income, and risk reduction. Bonds provide predictable cash flows and help offset the volatility of equities, especially during market downturns. He explains that bond returns are largely driven by current yield, not speculation. Over time, a bond's return closely approximates its yield at the time of purchase, adjusted for changes in interest rates and credit quality. This makes bond returns more predictable than stock returns, but also more limited. Bogle addresses the fear that rising interest rates will destroy bond returns. He acknowledges that rising rates can cause short-term price declines, but emphasizes that higher rates ultimately benefit long-term bond investors. As new bonds are issued at higher yields, investors who hold bonds over their intended duration generally recover from interim price fluctuations. Another key point in this chapter is the danger of reaching for yield. In an attempt to boost returns, investors often move into lower quality bonds, long-duration bonds, or complex bond funds. Bogle warns that these strategies increase risk without reliably improving outcomes. Credit risk, in particular, can undermine the protective role bonds are supposed to play. Bogle also critiques active bond management. While bond markets may appear less efficient than stock markets, the advantages of active trading are frequently offset by higher costs, turnover, and taxes. As with equities, bond investors must contend with the arithmetic of investing costs reduce net returns with certainty. He advocates for high-quality, low-cost bond funds, preferably broad market index funds. Such funds provide diversification across issuers and maturities while keeping expenses low and behavior manageable. The chapter reinforces that bonds are not a performance engine, but a risk management tool. Investors who abandon bonds in pursuit of higher returns often expose themselves to greater volatility and emotional decision-making. The takeaway from Chapter 7 is straightforward. Bonds belong in most portfolios, not to generate excitement, but to provide balance, income, and stability. Bogle's conclusion is that bonds may feel like a treadmill, but they are a treadmill that keeps investors moving forward without falling off the track. In Chapter 8, John C. Bogle examines the case for international investing and challenges the widespread belief that investors must aggressively seek returns outside their home market. While acknowledging the benefits of global diversification, Bogle urges investors to approach it with realism rather than enthusiasm. Driven by recent performance, Bogle begins by explaining why global investing became popular. As foreign markets periodically outperform the U.S. market, investors are drawn by the idea that opportunities abroad are acres of diamonds waiting to be discovered. However, Bogle warns that this mindset often leads to performance chasing, not sound portfolio construction. A central point in this chapter is that U.S. investors already have substantial global exposure. Many American companies generate a large portion of their revenues and profits overseas. As a result, investing in U.S. stocks already provides indirect international diversification. This reduces the necessity of heavy allocations to foreign markets. Bogle also highlights the additional risks associated with international investing. These include currency risk, political risk, regulatory differences, and higher costs. Currency fluctuations, in particular, can significantly impact returns and are unpredictable over both short and long periods. Unlike business fundamentals, currency movements do not reliably reward long-term investors. Another key issue Bogle raises is cost efficiency. International funds typically have higher expense ratios, higher turnover, and greater trading costs than domestic funds. Taxes can also be less favorable due to foreign withholding and complex tax structures. These costs directly reduce net returns and compound over time. Bogle does not argue against international diversification entirely. Instead, he advocates moderation and simplicity. A modest allocation to international stocks may provide diversification benefits, but excessive exposure often adds complexity without reliably improving long-term outcomes. He also cautions against the belief that foreign markets will consistently outperform the U.S. market. Leadership between domestic and international markets rotates unpredictably. Investors who shift allocations based on recent results often underperform due to poor timing. Bogle reinforces a recurring theme. The investor's job is not to search endlessly for better markets, but to build a disciplined, low-cost portfolio. Geographic diversification should serve that goal, not distract from it. The takeaway from Chapter 8 is balanced and practical. Global investing can play a supporting role, but it should not dominate a portfolio or be driven by hope of superior returns. Investors are often better served by recognizing that many of the diamonds they seek abroad already exist at home. Bogle's conclusion is consistent with his broader philosophy. Keep diversification broad, costs low, expectations realistic, and behavior disciplined. In Chapter 9, John C. Bogle tackles one of the most persistent beliefs in investing, that it is possible to consistently identify superior mutual funds in advance. He compares this search to the hunt for the Holy Grail, tempting, romantic, and largely futile. Bogle begins by acknowledging that some mutual funds do outperform the market over certain periods. However, the critical question is not whether outperformance exists, but whether investors can reliably identify those funds before the fact. Based on extensive historical evidence, Bogle's answer is no. A key point in this chapter is the lack of persistence in fund performance. Funds that rank at the top in one period often fall back to average or worsen the next. Performance leadership rotates unpredictably, driven by market cycles, style shifts, and random factors. As a result, selecting funds based on past returns is an unreliable strategy. Bogle also explains how costs distort the odds. Even if two funds have similar gross returns, the fund with higher expenses, higher turnover, and greater tax inefficiency will deliver lower net returns to investors. Bogle emphasizes that expenses are one of the strongest predictors of future performance, and they work in reverse. Lower costs increase the probability of better outcomes. Another issue Bogle highlights is survivorship bias. Investors typically see performance data only for funds that still exist. Poorly performing funds are often merged or liquidated, disappearing from databases. This creates a misleading impression that selecting winning funds is easier than it actually is. He also criticizes the over-reliance on ratings systems and fund rankings. While these tools appear objective, they are backward-looking and cannot account for future market conditions, changes in management, or asset growth. Funds that attract large inflows after strong performance often struggle due to increased size and reduced flexibility. Bogle discusses the role of luck versus skill in large fund universes. Some managers will outperform purely by chance. Distinguishing luck from skill in advance is extremely difficult, even for professionals. Investors who assume skill where none exists often take on unnecessary risk. Rather than chasing superior funds, Bogle recommends a probability-based approach. Instead of trying to find the best fund, investors should aim to maximize their chances of success by minimizing costs, reducing turnover, maintaining diversification, and staying disciplined over time. The takeaway from Chapter 9 is direct and practical. The search for superior funds is usually a losing game. Investors are better served by accepting market returns through low-cost, broadly diversified funds than by chasing performance and hoping to beat the odds. Bogle's conclusion reinforces the book's central theme: simplicity and realism outperform hope and speculation over the long run. In Chapter 10, John C. Bogle explains the powerful but often ignored concept of reversion to the mean, and why misunderstanding it leads investors to make consistently poor decisions. This principle states that extreme performance, good or bad, tends to move back toward the long-term average over time. Bogle begins by showing how reversion to the mean applies across financial markets, asset classes, investment styles, and mutual funds that experience unusually strong performance often attract massive investor attention and inflows. However, those high returns are rarely sustainable. As valuations rise and expectations become elevated, future returns tend to decline toward historical norms. He explains that this phenomenon is not mysterious, it is mathematical and behavioral. Strong performance increases prices faster than fundamentals, while weak performance depresses prices below intrinsic value. Over time, earnings growth and dividends reassert themselves, pulling returns back toward the average. A key mistake investors make is extrapolating recent success into the future. When a fund, asset class, or market has performed well for several years, investors assume it represents a new trend or superior strategy. In reality, Bogle argues, the opposite is often true. High past returns frequently signal lower future returns, and low past returns often set the stage for recovery. Bogle connects reversion to the mean directly to poor investor behavior. Investors tend to buy what has already gone up and sell what has gone down. This performance-chasing behavior leads them to enter investments near market peaks and exit near bottoms, locking in losses and missing recoveries. Another important point in this chapter is that mean reversion punishes forecasts and rewards discipline. Investors who attempt to predict which markets or funds will continue outperforming are betting against a long historical pattern. Those who maintain diversified portfolios and rebalance periodically benefit from mean reversion without trying to predict it. Bogle also highlights how the investment industry exploits this misunderstanding. Marketing materials emphasize recent winners, reinforcing the illusion that past performance is a reliable guide. In reality, such marketing encourages investors to systematically buy high and sell low. The chapter reinforces a central theme of the book. Successful investing is not about forecasting, but about probability and behavior. Mean reversion is a natural force in markets, and investors can either fight it or let it work in their favor. The takeaway from Chapter 10 is clear. Be skeptical of extremes, resist performance chasing, and stay disciplined. Over time, markets correct excesses, and investors who understand reversion to the mean avoid costly mistakes and improve long-term outcomes. In Chapter 11, John C. Bogle explores a psychological trap that undermines long-term investing: investment relativism. This concept describes the tendency of investors to judge success, not by whether they achieve their financial goals, but by how their results compare to others or to market benchmarks. Bogle begins by explaining that investors often measure satisfaction in relative terms. An investor may earn a solid long-term return and still feel disappointed if the market or a neighbor did better. This mindset shifts the focus away from personal objectives and toward constant comparison, which Bogle argues is a major source of investor misery. A central theme of this chapter is that relative performance is largely uncontrollable. Markets move unpredictably, and there will always be asset classes, strategies, or investors that outperform in any given period. Chasing relative winners often leads to unnecessary changes in strategy and higher risk-taking, which can jeopardize long-term goals. Bogle emphasizes that the true purpose of investing is absolute success, not relative victory. Absolute success means earning a reasonable return that meets one's financial needs, funding retirement, preserving purchasing power, and achieving financial security. Relative success, by contrast, is an endless race with no finish line. He also connects investment relativism to poor behavior. Investors who focus on benchmarks or peer performance are more likely to abandon sound strategies. During periods of underperformance, this behavior increases turnover, raises costs, and often results in buying high and selling low. Another important point in this chapter is the role of expectations. Unrealistic expectations, fueled by market hype or short-term performance comparisons, lead to frustration and dissatisfaction. Bogle argues that investors who set realistic expectations and understand market limitations are far more likely to stay disciplined and achieve satisfactory outcomes. Bogle also criticizes the investment industry's emphasis on rankings, league tables, and quarterly comparisons. These tools encourage short-term thinking and reinforce the belief that constant outperformance is both necessary and achievable. In reality, most investors cannot and do not need to beat the market to succeed. The chapter reinforces the idea that behavioral control is as important as portfolio construction. Investors who remain focused on their own plan, rather than external comparisons, reduce stress and improve long-term results. The takeaway from Chapter 11 is clear. Happiness in investing comes from meeting your own goals, not from beating others. By rejecting investment relativism and embracing long-term discipline, investors can avoid unnecessary misery and build a more stable and satisfying financial future. Bogle's message is practical and timeless. Stop comparing, stay the course, and define success on your own terms. In Chapter 12, John C. Bogle examines a structural problem that undermines many successful mutual funds: asset growth. While growing assets may appear to be a sign of success, Bogle argues that beyond a certain point, size becomes an enemy of performance. Bogle begins by explaining how strong performance attracts investor inflows. When a fund outperforms its peers, money pours in often rapidly. As assets grow, the fund manager is forced to deploy increasingly large amounts of capital. This makes it harder to replicate past strategies, especially in less liquid markets or narrower investment styles. A key point in this chapter is that what works at small scale often fails at large scale. Smaller funds can move in and out of positions more efficiently, exploit niche opportunities, and manage risk more precisely. As funds grow larger, flexibility decreases. Trading costs rise, market impact increases, and opportunities become diluted. Bogle emphasizes that asset growth often benefits fund companies more than investors. Larger funds generate higher fee revenue, even if performance declines. This creates a conflict of interest. Fund sponsors are incentivized to keep funds open and growing long after optimal size has been exceeded. Another issue Bogle highlights is performance decay. Historical data shows that funds with rapid asset growth following strong performance tend to underperform in subsequent periods. Investors who chase these funds often arrive after the best results are already behind them. Bogle also discusses the difficulty of closing funds to new investors. While some managers recognize that limiting asset growth would protect performance, closing a fund is rarely popular within fund organizations. Marketing pressure and revenue considerations often override long-term investor interests. Importantly, Bogle connects asset size to indexing. Index funds, he explains, are largely immune to the size problem because they are designed to own the entire market. As the market grows, index funds grow naturally without distorting their strategy or increasing costs disproportionately. He reinforces a recurring theme. Investors should evaluate fund structure, not just past returns. A fund's size, turnover, and cost profile are often more predictive of future results than recent performance rankings. The takeaway from Chapter 12 is clear. Success attracts size, and size often erodes success. Investors who ignore this relationship risk disappointing results. Bogle's conclusion is practical and consistent with his philosophy. Beware of asset growth. Be skeptical of past performance, and favor structures like low-cost index funds that are not harmed by success. In Chapter 13, John C. Bogle focuses on a factor that is frequently overlooked by investors, but has a powerful impact on long-term results: taxes. He argues that while taxes may seem secondary to returns, what ultimately matters is what investors keep after taxes, not what they earn before them. Bogle begins by explaining the concept behind the chapter's subtitle, The Message of the Parallax. A parallax is a shift in perspective, and Bogle uses it to show how investors often view returns from the wrong angle. Pre-tax performance looks attractive, but post-tax performance tells the real story. Ignoring taxes creates a distorted picture of investment success. A key point in this chapter is that tax efficiency varies widely across investment strategies. Funds with high turnover generate frequent taxable events, such as capital gains distributions. Even when investors do not sell shares, they may still owe taxes due to fund trading activity. These taxes reduce compounding and permanently shrink long-term wealth. Bogle emphasizes that taxes compound just like costs. A small annual tax drag may seem insignificant, but over decades it can reduce terminal wealth dramatically. Investors who focus only on nominal returns often underestimate this impact. Another important distinction Bogle makes is between taxable and tax-advantaged accounts. Strategies that involve high turnover or frequent income distributions are particularly harmful in taxable accounts. Investors should align asset placement with tax characteristics, holding tax-efficient assets in taxable accounts and tax-inefficient assets in tax-deferred or tax-exempt accounts when possible. Bogle also critiques the tendency of fund managers to ignore after-tax results. Mutual funds are typically marketed based on pre-tax performance, even though many investors hold them in taxable accounts. This creates a disconnect between reported success and investor reality. Index funds play a central role in this chapter because they have low turnover and minimal trading. Index funds are inherently tax efficient. They distribute fewer capital gains and allow more returns to compound over time. Bogle presents indexing as one of the most effective tools for reducing tax drag, without sacrificing diversification or discipline. The takeaway from Chapter 13 is clear and practical. Taxes are a controllable cost, and ignoring them is a mistake. Investors who manage taxes thoughtfully improve their long-term outcomes, without taking additional risk. Bogle's conclusion reinforces a core principle of the book. It's not what you earn that counts, it's what you keep. By focusing on after-tax returns, investors gain a clearer, more realistic view of investment success and make better long-term decisions. In Chapter 14, John C. Bogle focuses on time as the most powerful and most misunderstood element in investing. He argues that time can either work as an investor's greatest ally or become a destructive force, depending entirely on behavior, costs, and discipline. Bogle begins by explaining the concept of compounding, which he describes as the magic of long-term investing. When returns are reinvested and allowed to grow over decades, wealth expands exponentially. However, this magic only works when investors remain invested and avoid unnecessary interruptions. He contrasts this with the tyranny of time. While compounding builds wealth, time also magnifies mistakes. High costs, frequent trading, poor timing, and tax inefficiency compound negatively year after year. Small disadvantage, when repeated over long periods, lead to dramatically worse outcomes. A key point in this chapter is that time rewards patience, not activity. Investors often believe that doing more trading frequently, adjusting allocations, or reacting to market news improves results. Bogle shows that excessive activity usually shortens effective investment time by increasing costs and triggering poor behavioral decisions. Bogle also addresses time horizon mismatch. Many investors say they are long-term investors, but behave like short-term traders. When markets decline, they abandon strategies designed for decades and make decisions based on weeks or months. This behavior undermines the very advantage that time provides. Another important theme is the cost of delay. Investors who postpone investing while waiting for better opportunities lose irreplaceable time. Because early years of compounding are disproportionately valuable, delays can permanently reduce lifetime returns even if later performance is strong. Bogle reinforces the importance of staying the course. Market downturns, while uncomfortable, are an unavoidable part of long-term investing. Investors who remain invested through downturns allow time to work in their favor. Those who exit and re-enter based on fear often miss recoveries and lock in losses. He also ties time to expectations management. Long-term investing does not produce smooth or predictable results. Investors must accept volatility as the price of long-term growth and understand that time smooths outcomes only when discipline is maintained. The takeaway from Chapter 14 is clear. Time itself is neutral. It amplifies whatever strategy and behavior an investor follows. Used correctly, time creates wealth. Used poorly, it compounds errors. Bogle's conclusion is practical and consistent with his philosophy. Start early, stay invested, minimize costs, and let time do the heavy lifting. In Chapter 15, John C. Bogle explains why clear, firm investment principles are essential for long-term success. He argues that investors do not fail because they lack information, but because they lack the discipline to follow sound principles consistently, especially during periods of market stress. Bogle begins by defining what he means by principles. Principles are not tactics or predictions. They are foundational rules that guide decision-making over decades. Examples include staying diversified, minimizing costs, remaining disciplined, and maintaining a long-term perspective. These principles must remain stable, even when markets and emotions are unstable. A key theme of this chapter is that flexibility is often mistaken for wisdom. Investors frequently abandon principles in the name of being adaptive or responsive to new market conditions. Bogle argues that this flexibility usually leads to market timing, performance chasing, and excessive risk-taking. True wisdom lies in maintaining discipline when it feels most uncomfortable. Bogle emphasizes that principles are tested during extremes. In bull markets, investors are tempted to abandon caution and chase higher returns. In bear markets, fear pushes investors to sell and seek safety at exactly the wrong time. Principles act as an anchor, preventing emotional reactions from overriding rational plans. Another important point in this chapter is the difference between strategy and noise. Markets generate constant information, economic data, forecasts, headlines, and opinions. Without firm principles, investors react to this noise and make frequent changes that increase costs and reduce returns. Principles filter noise and keep decisions aligned with long-term goals. Bogle also connects principles to organizational integrity within the investment industry. He argues that fund managers and firms that lack firm principles often prioritize asset gathering, marketing, and short-term rankings over investor outcomes. By contrast, principled organizations focus on stewardship, transparency, and long-term value. He reinforces the idea that principles must be simple and understandable. Overly complex rules are difficult to follow and easy to rationalize away. Clear principles make it easier for investors to stay the course when emotions run high. Throughout the chapter, Bogle stresses that consistency compounds. Investors who apply sound principles year after year benefit not only from market returns, but from better behavior and lower costs. Inconsistent application, even of good ideas, undermines results. The takeaway from Chapter 15 is direct. Investment principles must be inflexible, even though markets are not. Investors who commit to a clear set of principles and follow them without exception dramatically improve their odds of long-term success. Bogle's conclusion reinforces his lifelong message: discipline beats brilliance, and principles matter more than predictions. In Chapter 16, John C. Bogle turns a critical eye toward marketing in the investment industry and explains how it shapes investor behavior, often to the investor's detriment. His central argument is that marketing does not merely communicate information. It actively influences decisions, expectations, and outcomes. Bogle begins by explaining that most investment products are sold, not discovered. Mutual funds are marketed using performance charts, rankings, slogans, and narratives designed to attract assets. These messages emphasize recent success, uniqueness, or manager brilliance, even though none of these factors reliably predict future returns. A key point in this chapter is that marketing focuses on what sells, not on what serves investors. Short-term performance is highlighted because it is easy to communicate and emotionally persuasive. Long-term discipline, cost control, and realistic expectations, while far more important, are harder to market and therefore receive less attention. Bogle explains that marketing encourages performance chasing, a behavior that systematically harms returns. Investors are drawn into funds after periods of strong performance, often just before returns revert to the mean. When performance weakens, marketing shifts attention elsewhere, and investors repeat the cycle. Another major issue Bogle raises is the misalignment of incentives. Fund companies profit from gathering assets, not from delivering superior long-term results. Marketing departments are rewarded for growth in assets under management, which can conflict with investor interests, especially when asset growth undermines performance or increases costs. Bogle also critiques the use of complex narratives and financial jargon. Complexity creates the illusion of expertise and innovation, but often masks higher costs and risks. Investors who do not fully understand what they own are more likely to react emotionally and abandon strategies during market stress. He emphasizes that marketing shapes expectations, and unrealistic expectations are dangerous. When investors expect consistent outperformance or smooth returns, normal market volatility feels like failure. This leads to disappointment, loss of confidence, and poor decision-making. Bogle contrasts this marketing-driven culture with an investor-first philosophy. He argues that the most honest message in investing is often the least appealing. Markets are unpredictable, returns are uncertain, and discipline matters more than excitement. The takeaway from Chapter 16 is clear. Investors must learn to see through marketing and focus on fundamentals. Understanding how investment products are sold helps investors resist emotional persuasion and make more rational decisions. Bogle's conclusion reinforces a core theme of the book: ignore the message, understand the medium, and judge investments by structure, costs, and long-term logic, not by advertising promises. In Chapter 17, John C. Bogle examines the role of technology in investing and asks a critical question. Has technological advancement actually improved investor outcomes, or has it mainly increased speed, complexity, and speculation? Bogle begins by acknowledging that technology has transformed financial markets. Trading is faster, information is more widely available, and data analysis is more sophisticated than ever. However, he challenges the assumption that faster and more powerful tools automatically lead to better results for investors. A central argument in this chapter is that technology has primarily benefited intermediaries, not long-term investors. High-speed trading systems, complex analytics, and real-time data encourage frequent trading and short-term decision-making. While these tools may increase efficiency at the transaction level, they often increase costs, turnover, and behavioral mistakes at the portfolio level. Bogle emphasizes that information overload is a hidden risk. Investors now have access to constant streams of market data, news, and opinions. Instead of improving decision-making, this abundance of information often leads to overreaction. Investors confuse activity with progress and mistake noise for insight. Another key point is that technology amplifies speculation rather than investment. Faster execution makes it easier to trade on short-term price movements, but it does not improve the long-term fundamentals of businesses. Bogle argues that long-term returns still come from dividends, earnings growth, and valuation, not from speed or prediction. Bogle also critiques the belief that advanced models and algorithms can reliably outsmart the market. While technology can process data more quickly, it cannot eliminate uncertainty or human behavior. Markets remain competitive, and any technological edge is quickly arbitraged away, leaving higher costs but no lasting advantage. Importantly, Bogle contrasts technology-driven activity with long-term discipline. The investor's greatest edge is not superior tools, but patience, low costs, and consistency. Technology that encourages frequent changes undermines these advantages. He also points out that index funds benefit from technology without being harmed by it. Technology reduces administrative costs, improves tracking accuracy, and enhances efficiency without increasing turnover or speculation. In this way, technology supports long-term investing only when paired with the right structure. The takeaway from Chapter 17 is clear. Technology is neutral. It magnifies behavior. Used poorly, it accelerates mistakes. Used wisely, it supports efficiency without changing strategy. Bogle's conclusion is practical and cautionary. Investors should ask not what technology makes possible, but what it makes productive. In investing, progress is measured not by speed or complexity, but by long-term outcomes. In Chapter 18, John C. Bogle examines the role of mutual fund directors and raises a fundamental governance question. Who do fund directors truly serve, the investors or the fund management company? This chapter focuses on conflicts of interest that exist within the mutual fund industry and how they affect investor outcomes. Bogle begins by explaining the formal responsibility of fund directors. In theory, directors are meant to act as fiduciaries for fund shareholders. Their job is to oversee management, negotiate fees, monitor performance, and ensure that funds are operated in the best interests of investors. In practice, Bogle argues, this responsibility is often compromised. The central problem, according to Bogle, is that fund directors frequently serve to masters. While they are supposed to represent shareholders, they are typically selected, compensated, and supported by the fund management company. The structural relationship weakens independence and makes it difficult for directors to challenge management on critical issues, especially fees. A major focus of the chapter is expense ratios. Bogle points out that fund fees are one of the most important determinants of long-term returns. Yet directors often approve fee structures that are far higher than necessary. He questions why economies of scale, lower costs as assets grow, are not passed on more aggressively to investors. Bogle also discusses the limited accountability of directors. Shareholders rarely vote against directors, and contested elections are extremely rare. As a result, directors face little pressure to actively advocate for investor interests. This lack of accountability allows excessive fees and inefficient practices to persist. Another issue Bogle raises is information asymmetry. Fund management companies control the data, analysis, and resources provided to directors. This makes it harder for directors to independently assess whether management decisions truly benefit investors or primarily serve corporate profitability. Bogle contrasts this structure with the governance model used at Vanguard, where funds are owned by their shareholders. In this structure, directors represent investors directly, and cost reductions benefit shareholders rather than an external management company. He presents this as evidence that governance structure matters. The takeaway from Chapter 18 is clear. Strong governance is essential, but often lacking in the mutual fund industry. When directors are not truly independent, investor interests suffer primarily through higher costs and weaker oversight. Bogle's conclusion reinforces a core theme of the book: structure drives outcomes. Investors should pay attention not only to performance and strategy, but also to governance and incentives. When directors genuinely serve shareholders, long-term results improve. In Chapter 19, John C. Bogle focuses on a foundational, but often ignored factor in investing success: organizational structure. He argues that structure is not a minor detail, it is a strategic imperative that largely determines whether investors or financial institutions capture the benefits of investing. Bogle begins with a clear principle: structure drives behavior, and behavior drives results. In the mutual fund industry, the way an organization is structured influences costs, incentives, decision-making, and ultimately investor outcomes. When structures are poorly designed, even well-intentioned managers are pressured to act against investor interests. A central theme of this chapter is the conflict inherent in the traditional mutual fund model. Most funds are operated by management companies, whose primary objective is to maximize profits for their owners, not returns for investors. This creates structural incentives to gather assets aggressively, charge higher fees, promote complex products, and prioritize marketing over stewardship. Bogle contrasts this with an investor-owned structure, where funds are operated for the benefit of shareholders, not external owners. In such a structure, economies of scale naturally flow to investors through lower costs, rather than being retained as corporate profits. Bogle presents this model as proof that better outcomes are not the result of superior forecasting, but of better design. Another key point in the chapter is that costs are structural, not accidental. High expense ratios persist not because they are unavoidable, but because existing structures allow and encourage them. Investors often underestimate how deeply structure influences long-term returns, focusing instead on performance metrics that fluctuate unpredictably. Bogle also emphasizes that structure affects corporate culture. Organizations built around sales, asset growth, and short-term rankings develop behaviors that undermine long-term investing. By contrast, organizations built around stewardship, fiduciary duty, and long-term value reinforce discipline and trust. Importantly, Bogle argues that individual investors cannot easily change industry structures, but they can choose where to invest. By selecting low-cost funds, investor-aligned organizations, and transparent structures, investors tilt the odds in their favor without relying on forecasts or market timing. The chapter reinforces a recurring message: investment success is not just about strategy. It is about environment. Even good strategies fail when embedded in flawed structures. Conversely, simple strategies succeed when supported by investor-first design. The takeaway from Chapter 19 is clear and practical. Choose structures that serve you, not structures that sell to you. Investors who understand how incentives work and align themselves with organizations built around stewardship dramatically improve their long-term outcomes. Bogle's conclusion is consistent with his lifelong philosophy: when structure is right, results tend to follow. In Chapter 20, John C. Bogle shifts focus from markets and funds to entrepreneurship, emphasizing the role of creativity, purpose, and long-term value creation in both business and investing. While this chapter is more philosophical than technical, it reinforces core economic principles that underpin sustainable investment success. Bogle begins by distinguishing entrepreneurship from speculation. True entrepreneurship, he argues, is about building productive enterprises that create real economic value over time. It involves innovation, long-term commitment, and responsibility to customers, employees, and society. Speculation, by contrast, focuses on short-term price movements and financial engineering without contributing lasting value. A key point in this chapter is that long-term investment returns ultimately depend on entrepreneurial success. Stock market returns are not generated by trading activity, but by businesses that grow earnings, reinvest capital wisely, and serve real needs. Investors, therefore, benefit most when they align themselves with productive enterprise rather than financial manipulation. Bogle also discusses the tension between ownership and control. Entrepreneurs typically think in decades, while public markets often reward short-term results. This mismatch can pressure companies to prioritize quarterly performance over long-term strategy. Bogle argues that excessive focus on short-term metrics undermines both corporate health and investor returns. Another important theme is intrinsic motivation. Bogle emphasizes that the most successful entrepreneurs are driven not solely by money, but by the satisfaction of creating something meaningful. This mindset leads to better decisions, stronger cultures, and more durable businesses. Financial rewards, in this framework, are the byproduct of value creation, not the primary objective. Bogle contrasts entrepreneurial thinking with the growing dominance of financial intermediaries, who extract value through fees and transactions rather than creating it. He warns that when finance becomes detached from enterprise, markets lose their connection to real economic growth. The chapter also reinforces the idea that investors should be owners, not traders. Long-term investors participate in entrepreneurship indirectly. By owning businesses through equity markets, frequent trading weakens this connection and shifts focus away from long-term value creation. The takeaway from Chapter 20 is that investing works best when it respects the principles of entrepreneurship, patience, stewardship, and commitment to real growth. Investors who understand this are less likely to chase short-term gains and more likely to benefit from long-term compounding. Bogle's conclusion ties entrepreneurship back to his broader philosophy: the joy of creating value, whether in business or investing, comes from building for the long run, not exploiting the short term. In Chapter 21, John C. Bogle addresses the role of leadership in the investment industry and explains why. Leadership quality has a direct and lasting impact on investor outcomes. He argues that leadership is not about charisma or short-term success, but about purpose, stewardship, and long-term responsibility. Bogle begins by defining true leadership as service. In the context of investing, leaders should serve investors, not exploit them. Their primary responsibility is to protect shareholder interests, maintain integrity, and ensure that the organization operates with a long-term mindset. When leadership lacks this sense of purpose, investor trust and outcomes deteriorate. A key theme of the chapter is the contrast between mission-driven leadership and profit-driven leadership. Bogle does not argue that profit is unimportant, but he stresses that when profit becomes the sole objective, it distorts decision-making. Leaders focused only on revenue growth tend to emphasize asset gathering, marketing, and product proliferation, often at the expense of simplicity, cost control, and investor value. Bogle emphasizes that leadership sets organizational culture. Leaders who prioritize stewardship encourage ethical behavior, transparency, and discipline throughout the organization. Conversely, leaders who tolerate conflicts of interest or short-term thinking create cultures that normalize excessive fees, performance chasing, and aggressive marketing. Another important point is that leadership requires moral courage. Standing up for investors may mean resisting industry norms, closing funds to protect performance, reducing fees voluntarily, or avoiding popular but harmful products. These decisions are rarely rewarded in the short term, but they define leadership quality over time. Bogle also highlights the importance of long-term vision. Effective leaders understand that investing is a multi-decade endeavor. Decisions should be evaluated not by quarterly rankings or asset flows, but by whether they improve investor outcomes over full market cycles. This perspective aligns leadership decisions with compounding and discipline. He contrasts genuine leadership with what he sees as a growing emphasis on corporate management over stewardship. In many firms, leaders act primarily as executives managing businesses rather than fiduciaries overseeing investor capital. This shift weakens accountability and erodes trust. The takeaway from Chapter 21 is clear. Leadership matters because it shapes structure, incentives, and behavior. Investors benefit most when leaders act as stewards with a clear sense of purpose, rather than as sales-driven executives. Bogle's conclusion reinforces one of his lifelong beliefs. The investment industry does not need more innovation, it needs better leadership. When leaders serve investors first, long-term success naturally follows. In Chapter 22, the final chapter of Common Sense on Mutual Funds, John C. Bogle brings the discussion back to its most fundamental element, people. After analyzing markets, costs, structures, and institutions, Bogle emphasizes that investing ultimately exists to serve human beings, both clients and the people who serve them. Bogle begins by stating that the financial system often loses sight of its purpose. When investing becomes overly focused on products, profits, and performance rankings, the human dimension is neglected. He argues that the true measure of success in the investment industry is not asset growth or market share, but whether clients' long-term financial needs are genuinely being met. A key theme of this chapter is trust. Investing is built on trust between clients and financial institutions. When that trust is broken through excessive fees, misleading marketing, or conflicts of interest, the system fails its core mission. Bogle stresses that trust must be earned through transparency, fairness, and consistent stewardship over time. Bogle also addresses the role of the crew, the employees, managers, and professionals who operate investment organizations. He argues that treating employees with respect, fairness, and purpose leads to better outcomes for clients. Organizations that value people over profits tend to develop stronger cultures, better judgment, and more ethical behavior. Another important point is the alignment of interests. Bogle reiterates that when the interests of clients, employees, and leadership are aligned, outcomes improve naturally. Misalignment where one group benefits at the expense of another inevitably leads to poor decisions and long-term damage. He criticizes the industry's tendency to view investors as accounts rather than individuals. Clients are often segmented, marketed to, and analyzed statistically, while their real goals, security, stability, and peace of mind, are overlooked. Bogle argues that investing should support life goals, not become a source of stress and confusion. Bogle also reinforces the idea of stewardship. Serving clients requires humility, honesty, and restraint. It means acknowledging uncertainty, avoiding unnecessary complexity, and putting long-term interests ahead of short-term gains. As the closing chapter, this discussion ties together the book's central message: structure, strategy, and discipline only matter because of their impact on people. Markets are tools, not ends in themselves. The takeaway from Chapter 22 is clear and human-centered. Investing should be guided by values, not just numbers. When clients come first and organizations act as responsible stewards, the financial system fulfills its true purpose. Bogle's final message is simple and powerful. Never forget that behind every investment decision is a human being depending on it. Common Sense on Mutual Funds is not a book about beating the market. It is a book about beating the mistakes that cause investors to lose to the market. Across 22 chapters, John C. Bogle delivers one consistent message: investing success is not driven by brilliance, prediction, or complexity. It is driven by structure, discipline, and common sense. Markets are unpredictable. Costs are certain. Behavior matters more than intelligence. Bogle systematically dismantles the myths that dominate modern investing. He shows why chasing performance fails, why active management struggles to overcome costs, and why complexity often exists to sell products, not to serve investors. Over and over, the evidence leads to the same conclusion: most investors would be better off owning the entire market at the lowest possible cost and staying invested for the long term. The book explains where returns actually come from: earnings growth, dividends, and valuations, and why speculation and forecasting add noise but not value. It highlights how asset allocation, time, and discipline matter far more than fund selection or market timing. It exposes how taxes, fees, turnover, and marketing quietly erode returns year after year. But this book is not anti-market. It is anti-illusion. Bogle respects capitalism, entrepreneurship, and long-term ownership of productive businesses. What he rejects is a financial system that prioritizes asset gathering, short-term rankings, and salesmanship over stewardship. He argues that when structures are misaligned, even well-meaning professionals end up serving themselves before investors. One of the most powerful lessons in the book is psychological. Investors don't fail because markets are unfair. They fail because they compare, chase, react, and abandon discipline at the wrong moments. Bogle's solution is not excitement, but clarity. Define success in absolute terms, ignore noise, and stay the course. By the final chapters, the message becomes deeply human. Investing exists to serve people, clients, families, retirees, not spreadsheets or quarterly leaderboards. When leadership lacks purpose, when governance fails, and when incentives are misaligned, investors pay the price. But when costs are low, interests are aligned, and discipline is maintained, long-term success becomes not guaranteed but highly probable. The ultimate takeaway is simple and uncomfortable. You don't need to do more, you need to do less. But do it right. Own the market. Keep costs low. Stay disciplined. Let time work. That's common sense. If this breakdown helped you see investing more clearly and not more complicated, hit the like button so this message reaches more investors who need it. If you want more no hype, evidence-based breakdowns of the best investing books ever written, subscribe to the channel. New videos every week, focused on long-term wealth, behavior, and real-world decision-making. And comment below, what's the hardest investing mistake you've had to unlearn? Thanks for watching, and remember, in investing, simple usually wins.